Students, today we are going to learn about issue of shares at discount. When the company issues the shares at a price which is less than the face value of the shares, then it is called issue of shares at discount. When the shares are issued at discount, it is a loss for the company. So normally the companies do not issue the shares at discount, and when these shares are issued at discount, a separate discount on issue of shares account is maintained and it is shown under the assets in the balance sheet till it is completely written off. And the journal entry for issue of shares as discount is given here. Share allotment account debit, discount on issue of shares account debit to share capital account. Here you can see that the entry is specially about the share allotment account, because normally the discount entry is passed along with the allotment, and since discount is a loss for the business as per the rule of nominal account, debit expenses and losses, therefore discount on issue of shares is debited in this journal entry. But you have to check this note that as per the new provisions of the Companies Act, the public issue of shares cannot be done at discount. Now we are going to learn one example. Ashwini Limited invited applications from the public for subscribing for 10,000 equity shares of rupees 15 each at a discount of rupees 1 per share, payable rupees 5 on application, rupees 9 on allotment. All the shares were applied and allotted. Money due on allotment was received. Pass journal entries in the books of Ashwini Limited and prepare balance sheet. Now always you have to remember that the investors, they have to apply for the shares by paying the application money. So the first entry is always for receiving the cash, because normally the application money is deposited in the bank and therefore the company's bank account receives the money or the funds. So bank account is always debited for the receipt of the share application money. Now here there are 10,000 shares and the application money per share is rupees 5. So 10,000 into 5, that is 50,000. So the first entry is bank account debit 50,000 to share equity share application account 50,000, and in the bracket we have to give the detailed explanation about the number of shares and the application money per share received. Then the second entry is for the transfer of the application money to the share capital account. Share capital account is a liability, so we have to credit share capital account by transferring the application money. So the second entry is equity share application account debit to equity share capital account. So always you have to remember, for the application, for allotment and for the call money, always there are two entries. Then after that the company decides to whom to allot or distribute the shares, and then the allotment letter is sent to the shareholders. At that time we have to pass the journal entry for the allotment of the shares. Now here the discount of rupees 1 is given to the shareholders and the allotment money is rupees 9 per share. So that is why we have to pass this entry, equity share allotment account debit rupees 90,000, that is 9 into 10,000 equity shares, so that comes to 90,000. Then since discount is a loss for the business, we have to debit discount on issue of shares account. And and here rupees 1 discount is given. So 1 into 10,000 equity shares, so that comes to rupees 10,000. That is the discount on share. Then to equity share capital account, that is for the transfer of this money or this entry to the share capital account, rupees 1 lakh. Then after that, the next entry is for receipt of the funds from the shareholders to whom the shares are allotted. Bank account debit 90,000 to equity share allotment account 90,000. You can see from this that the shares are, the allotment money is actually rupees 10 per share. So shares are worth of rupees 1 lakh, but then the discount of 10,000 is given, that is rupee 1 per share is given. So that is why the company will receive only rupees 90,000 by allotment. So the fourth entry is for the receipt of the allotment money. Then the extract of the balance sheet is given here. On the liability side, share capital 10,000 equity shares of 15 each. So that is 1,50,000. Then bank account is shown, that is the bank balance. So here in the first entry, bank account is debited for rupees 50,000. Then you have to check in all the entries. Here in the fourth entry, bank account is debited again for rupees 90,000. So 90,000 plus 50,000, our bank balance is rupees 1,40,000. And then there is a discount on shares which is showed under assets until it is completely written off. So discount on issue of shares is rupees 10,000. Therefore the total of the balance sheet on the liability and asset side is equal, that is rupees 1,50,000. Next we are going to learn about the oversubscription of shares. Now whenever the company decides to issue certain number of shares in the market, sometimes it gets good response from the investors and more investors are willing to buy the shares. So more investors apply for the shares. For example, company has issued 15,000 shares in the market, but the company receives the applications for 18,000 shares. Then 3,000 shares is called the 3,000 share applications are called the oversubscription. It means more investors, they apply for the shares. Now what happens? See the first step. The company can act in these three ways. First step, some applicants are fully allotted the shares. Suppose any shareholder has applied for 5,000 shares and the company decides to allot full 5,000 shares to that shareholder, then it is called full allotment. Then for some applicants, the company does not want to allot the shares. At that time, the application money will be refunded to that shareholder. So share application account debit to bank account because cash goes out of the business. Then the third one is the partial allotment. Here the company gives certain number of shares for against the shares applied for. For example, a shareholder has applied for 2,000 shares, but the company wants to allot only 1,000 shares to that shareholder, but he has paid the application money on 2,000 shares. At that time, the excess application money is adjusted with the allotment money. So that we are going to study from the next example which is given here. Vaishali Limited issued 10,000 equity shares of 10 each at par, payable rupees 3 on application, rupees 4 on allotment and rupees 3 on first and final call. The company received applications for 15,000 shares. The board of directors rejected 5,000 applications and application money was refunded. All the money was duly received. So journal entries in the books of Vaishali Limited. Now from this information you can find out that the company has issued 10,000 equity shares in the market, but the company actually received the applications for 15,000 shares. So this is the case of oversubscription. Here 5,000 excess applications are received by the company. Therefore, our first journal entry will be for receiving the application money. So here 15,000 applications are received and the application money is rupees 3 per share. So in our first journal entry, where we are going to debit the bank account because money comes in the bank, we have to multiply 15,000 shares with 3, that is 3 per share on application. So that comes to 45,000. So that is our first journal entry, that is bank account debit 45,000 to equity share application account 45,000. While the directors have rejected 5,000 applications and the application money was refunded, it means the application money of rupees 15,000 will be refunded, that is 5,000 into 3, that comes to 15,000. So here the journal entry, third journal entry is given, equity share application account debit 15,000 to bank account because this much money goes out of the business. While for the 10,000 shares, the application money will be transferred to the equity share capital account because that is the actual issue of shares. The actual number of shares issued are 10,000. So 10,000 into 3, that is rupees 30,000 will be transferred to the equity share capital account. Either you can pass the combined entry here, that is equity share application account debit 45,000 to equity share capital account credit 30,000 to bank account 15,000, or else like this you can pass separate entries, that is first entry they have passed for the transfer of shares application money to equity share capital account. So the entry is equity share application account debit 30,000, that is 10,000 into 3 to equity share capital account, and the third entry is for the refund of the excess application money. The excess applications are 5,000. So 5,000 into 3, 15,000 is refunded to the applicants. So equity share application account debit to bank account. Then the next is, here the face value of the shares is 10 and the company is going to receive rupees 3 on application, then rupees 4 on allotment and rupees 3 on first and the final call. So after passing the entry for the share application account, we are going to pass the entry for the allotment money. Now rupees 4 will be received on allotment, and when the letter will be issued to the shareholders for the allotment of shares, first we have to pass this entry, that is the fourth entry. Here there is a printing error, this 2 is by mistake they have printed, so ignore it. So our fourth entry is equity share allotment account debit, that is 10,000 into 4, that is 40,000 to equity share capital account 40,000. Then the next entry is for receipt of the allotment money, that is bank account debit because the money will be deposited in our bank account to equity share allotment account 10,000 into 4, 40,000. Then the next is for the first and the final call, that is rupees 3 will be received on first and final call. So 3 into 10,000 equity shares, that is 30,000. So when the letter is sent to the shareholders to pay the call money, that time the entry for the transfer of first and final call to share capital will be passed. Equity share first and final call account debit 30,000, that is 10,000 into 3 to equity share capital account 30,000. And when this first and final call money is received by the bank, our bank balance increases, bank receives the money, so bank account debit 30,000 to equity share first and final call account.